Whether you're importing or exporting, your business may experience cash flow shortages. Trade finance takes care of these gaps in cash flow, allowing you some much needed financial breathing room. Hi, I'm Peter Nicolau, founder of Peak Capital, an independently owned and operated commercial finance brokerage firm. If you're a small business owner thinking of either selling overseas or importing products and equipment into Australia, obtaining trade finance can help you do that without tying up your working capital. Basically, trade finance is an umbrella term that covers a range of finance products that help facilitate trade between businesses by introducing a third party into the transaction. The third party is usually a bank or financial institution that provides a range of solutions to address the complications that can arise while trading. The benefit of trade finance is usually twofold. For starters, it increases liquidity to make the purchase and helps mitigate some of the risk. For buyers, purchasing goods can make a significant dent in working capital, which can create cash flow gaps. Being able to access trade finance allows importers to fund the purchase of goods and generate revenue without suffering these cash flow gaps while waiting for the goods to arrive. And then for suppliers, working with a large client or offering extended payment terms can also result in a working capital shortage. So trade finance can be beneficial here too. From a risk perspective, most sellers would prefer to receive a payment upfront to avoid the risk that a buyer will be unable to pay for the goods once they have been shipped. But most buyers would prefer extended payment terms to ensure the goods are shipped and to avoid the risk of paying for goods that aren't received. Trade finance aims to bridge those gaps. Generally, how it works is that importers orders goods from a supplier. Once they have received the invoice from the supplier, is sent to the bank or financial provider, and they will provide the funds to pay the invoice. Once the importer receives the goods to use or sell, they can pay the invoice amount back to the bank or finance provider. The same can be said for exporters. They can approach a financial institution to provide them with the funds they need to manufacture the order. Once they receive the funds for the order, they can repay the finance. This particular example is known as export or import finance, which is one type of trade finance. There are a few other types of trade finance options too, so they don't necessarily all work like my previous example. Letters of credit, for example, are situations in which the financier provides a letter of credit to the seller, assuring them that they will receive payment for the goods. The buyer, meanwhile, receives assurance that the goods will be made and shipped. Or, with payment against documents, a documentary letter of credit, the supplier shows documentation that the shipment is on its way. When the financier receives the documents, they will transfer the payment to the supplier. This gives importers peace of mind that they will receive their goods. Then there is also payment in advance, known as open account, where the seller receives the payment in advance arranged by the financier to manufacture the goods ordered. So when you need to work out what type of service you need, how much finance your business requires, and what you can afford. As you can see, though, trade finance works slightly different to normal business loans in that the advance funds are based on your supplier invoices and paid directly to your supplier. It's worth noting that the application often requires extensive information, including a business plan that details the goals of the business and any significant accomplishments. It also includes information on key stakeholders, an introduction of the product or service that is being offered, an overview of the sector, and a summary of any and all anticipated results. The financial institution or lender may request information on all current assets owned by the business, including any current debts and overdrafts. Your best chance of succeeding is by approaching a broker who can help you assess your financial situation and identify the best solution for you. Ideally, you need to go with an option that has a repayment structure that won't impact your cash flow. The financing terms for pre and post shipment financing will also differ between the lenders, so you need to assess how this aligns with your processes. So definitely consider the prospect of working with a broker who is going to leave nothing to chance and is going to help you create more opportunities for business growth with a trade finance loan.